Hello and welcome back to our workshop here in Lisa Guevara Online Bookkeeping. We are going to discuss mastering adjustments. So before we start, let me introduce myself. My name is Lisa. I'm a CPA, a QuickBooks Pro advisor, also a Zero certified advisor, and a business owner. So welcome back. Welcome to our today's training session. As I've said, we are going to discuss mastering adjustments. So we are going to define what is adjusting entries, why do we need to adjust, when and how to prepare adjustments, and its effects to the financial statements. So first, let us discuss what are adjusting entries. Our adjusting entries are journal entries recorded at the end of an accounting period to alter the ending balances in various general ledger accounts. So what that means is, for example, if your fixed asset, you are recording a straight line depreciation for each month for that asset. So let's say that the asset costs 10,000 and you are uh, and the estimated useful life of that asset is 10 years. So that would be the estimated depreciation for that asset is 1,000 a year. So let's say that we are going to prepare the adjusting entry for 1 month. So 1,000 divided by 12 months, that would be 83. So in order to get the book value of that asset for the period, for the month, for this month, you are going to prepare the adjusting entry for the depreciation so that we could be able to get the book value of the asset and adjust its ending balances for the month. Okay, so that is adjusting entry. It is a journal entry that consists of the debit and credit side with the amount of the adjustments. So why are we making adjusting entries? First is to closely align the reported results and financial position of a business with the requirements of an accounting framework such as GAAP or the International Financial Reporting Standards or IFRS. So what does this means? This means that we are adjusting the records in order to uh, put put it or to match it, or in order to make the financial statements in keeping with the generally accepted accounting principle or IFRS. So what does this involve? It involves the matching of the revenues to the expenses under the matching principles. So uh, it impacts the reported revenue and expenses. So in other words, the adjusting entries are used to produce more accurate financial statements. So when are we going to make adjusting entries? Adjusting entries are created at the end of a reporting period, such as the end of the month, a quarter, or year. So, what are the common types of uh, adjusting entries? One is to record depreciation and amortization. Depreciation refers to the uh, expensing of the cost of a fixed asset over a period of time over its estimated useful life. Amortization refers to to intangible assets. Another is the to record an allowance for doubtful accounts. These are for those receivables that have been outstanding for a long time, and uh, you make an allowance if ever you will not be able to collect. So for example, if you have more than 90 days of an accounts receivable and it is the policy of your business to make a 10% allowance for such uncollected receivables, you will uh, adjust your accounts receivable and provide for an allowance for doubtful accounts by debiting doubtful accounts and crediting allowance for doubtful accounts. And then we can also adjust to record a reserve for obsolete inventory. For example, um, we are in the process of phasing out some of the accessories for a product, and then at the end of the accounting period it's not yet obsolete, but in the coming years it will become obsolete, so we or in the coming months it will become obsolete, so we can uh, record uh, an amount in order to cover for that obsolete inventory. We can also adjust to record a reserve for sales returns. For example, usually um, in e-commerce there are a lot of returns. So for example, it is a policy of your business to make an allowance for sales returns based on 10% of your sales. You will um, debit sales and credit sales returns allowance. Yes. And then to record the impairment of an asset. For example, it is becoming obsolete. For example, a machine has is becoming obsolete for the next few months. You will prepare an impairment uh, allowance for such an asset. Next, we have to record an asset retirement obligation. We also have, we can also adjust to record a warranty reserve, accrued revenue, and to record previously billed but unearned revenue as a liability. Next, we have record any accrued expenses, and also to record any previously paid but unused expenditures as prepaid expenses. And also, we can also adjust the cash balances for any reconciling items noted in the bank reconciliation. So, um, we are from all of these, we can say that these common types of adjusting entries can be uh, grouped into four types. We have the accrual entry, which is used to record a revenue or expense yet been that has yet um, that has not yet been recorded through a standard accounting transaction. Next, we have the deferral, which is used to defer a revenue or expense. And next, we have the uh, the estimate to estimate the amount of a reserve, for example, the allowance for doubtful accounts and obsolescence of inventory. And the last is recording of errors. Okay, so we are going to illustrate to you each one um, of these types of entries so we can understand it better.